Hi everyone, this is Investing Club. In this video, I want to talk about the right way that companies should do stock buybacks and how the way most companies do stock buybacks are completely wrong and results in these companies basically eating themselves alive. So before I start the video, be sure to leave a thumbs up on this video, subscribe to the channel if you haven't already. I always appreciate the support from all of you, and let's get right into the video. I think a very important thing is to look at the history of stock buybacks. And this guy right here, Henry Singleton, is considered to be the first person to effectively use stock buybacks. And Warren Buffett called this man one of the greatest capitalists and capital allocators of all time. So this is someone Warren Buffett thinks very highly about. Henry Singleton was the founder of Teledyne, and if you invested in Teledyne, and over the 25 years that Henry Singleton ran this company, they generated an annual return of around 18% over 25 years, which is a 53 times return on invested capital versus only 6.7 times for the S&P 500. So during this period, Teledyne vastly outperformed the S&P 500. And as I will show you, this is mainly because of how Henry Singleton used stock buybacks. So one important thing that Henry Singleton did was issue shares when they were highly priced. When Teledyne's share price was flying, he used it as a currency with which to make acquisitions, and he made around 130 acquisitions during this time. And this by itself is nothing special. A lot of companies issue more shares to finance an acquisition. That's pretty common. But what most other companies don't do is when the cycle turned and Teledyne's shares were falling, he repurchased them. And between 1792 and 1984, he reduced the share count of Teledyne by 90%. So this is someone who, when their shares are overpriced, he issues them and uses them as a currency for acquisitions. And when the shares are cheap, he buys them back. And over these 12 years, he bought 90% of the shares on the open market back, which resulted in the share price flying up. And this is the basic principle of how companies should use stock buybacks. You should buy back stocks when the stocks, not all the time, but only when the stocks are cheap. But this is not how most companies do it. Most companies will come out with an announcement saying they've dedicated a certain amount of dollars to repurchasing shares over a period of time. So I pulled up an announcement like this. This is from all the way back in 2013, and Boeing announced a 10 billion share buyback program. And even though this sounds great and gets a lot of investors excited, it actually doesn't mean much and can actually be harmful to the company. Because when a company announces a share buyback like this just means that every quarter, every year, they're going to buy back a set amount of shares, regardless of what the share price is and if it's expensive or cheap. Now we can look at Boeing's long-term price chart, and they announced their share buyback plan back in 2013, and look what happened as a result. Shares went up from around $100 all the way to $400. And I think that a big part of this increase was share buybacks. But I want you to notice what has happened now. Shares have plunged all the way back down to $100. Now this is a company that will need a bailout from the government, most likely, because they really have no cash reserves. And so now what I want you to ask yourself is, instead of starting the buyback back in 2013, what if this company still set aside an amount for buybacks, but only would buy back shares when it was optimal to do so, when the shares were cheap? The price still likely would have increased, but now, down at $100, this company would have a huge supply of cash to start buying back the shares like crazy. And doing buybacks like this would have resulted in a much better outcome than this for Boeing. If Boeing started buybacks here when the share price was falling, it would not have fallen nearly as much, from 400 all the way down to 100. Now, Warren Buffett illustrates this example of why share buybacks aren't a good idea when stocks are overpriced. He says, let's use this example of a partnership, and there's 3 partners, each with an investment of $1 million, and so total the partnership's worth $3 million. And one partner can offer the other 2 partners a choice to buy back their shares. And we can look at 3 scenarios. In the first scenario, the first partner offers a price of $1.1 million. And so in this case, would the other 2 partners accept his offer? Probably not, because they would be overpaying for his part of the business. Another situation is where the offer for the shares is at par, which means he offers his third for $1 million. And again, the other partners would likely reject this again. Why? Because buying out his equity at par doesn't really increase their returns at all. They still have the same price per share. The only thing it really does is a drain for their money to go into, which means that they can no longer use this cash for other purposes in the business. But in the third scenario, if the first partner offered their shares for only 0.9 million, then the other partners would definitely accept this because it is a good deal, right? It would automatically generate wealth for the remaining shareholders because their investment, they would be paying 1.45 million for their investments, but the total value is 1.5. So this is just a simple example that illustrates why it doesn't really make sense to buy back shares when they are overpriced. And even though that might sound complicated, it's really not. Warren Buffett has a plan for buying back shares. He says he buys back shares when they're trading for less than 1.1 of their book value, right? When Warren Buffett's Berkshire Hathaway shares are trading below 110% of their book value, that's when he will buy back shares. And that is just a simple, very, very simple way of limiting when you buy back your shares. Warren Buffett's idea is if the share price goes above 1.1 times their book value, then they are overpriced and they're no longer worth buying. And so I think if more companies took this approach instead of just blindly buying back shares, then they would be in much better situations than they are now. If you look at retail companies and how much they've been struggling, a lot of these companies like Macy's have authorized billions of dollars in share repurchases over the past 10 years. If instead of buying back shares and artificially inflating their price for the past 5 years and now witnessing a crash, if they saved this money to buy back shares at an opportune time, they would be doing it right now when their share prices are at an all-time low from a valuation standpoint. Share buybacks at this point in time would keep their prices up and would keep the prices from falling to where they are now, because when you have billions of dollars of buying pressure, the stock price is unlikely to drop further. So this is just something I wanted to talk about because I think it's important, especially now. When I'm looking for companies now, I want to see companies that are using buybacks opportunistically, not just blindly doing share buybacks. If I do see a company I love and they have done just blanket share buybacks in the past, it's not a disqualifier for me, but I feel much better about a company that has a CEO who understands the importance of doing share buybacks properly. If you learned something from this video, be sure to hit the thumbs up button and subscribe to the channel. I post stock market related videos multiple times a week, and I will see you on the next video.